copy and paste our down case, case. Outline your assumptions, impact on sales. So we have, I know we removed, let's see here, let's add up all of our sales here. And we still haven't done our terminal value. So the difference is, okay, so we've removed $2.5 billion worth of sales. However, we still need to do our terminal growth rate, which will really change things quite a bit. Anyways, we got our, let's just put our down case in here. Copy and paste. You know, kind of take a look at so you can just add some, you know, assumptions on the down case, population, GDP, costs, goods sold, etc. Now, we need to actually take a look at our free cash flow. We need to come up with our valuation. So, valuation base, before we get into our base case, down case, we need to know what our WACC is. So we'll take a look at cost of capital. So we need to know our cost of capital. Cost of capital. Cost of equity, cost of preferred. I don't even know if they have pref shares here. Just assume they don't for now. Come back if they do. Cost of debt. Okay. So cost of equity is our CAPM model. CAPM. We need to know our beta, our risk-free rate, and our risk premium over the market. And that'll be that. So I think we said that beta could be taken from Google or Finance Yahoo. They also provide it on Morningstar. I'm going to use that one. You should, you know, in later years be able to figure out how to calculate it. But you know, just in the interest of time, we'll just use this. So 0.59. Just want to compare that with Google Finance, see what they got. So they could use different different numbers in their calculations. So Loblaws. This guy, whoa, 0.006. 0.059. That's a big difference. Let's check Finance Yahoo. I don't know where that is. Let's try TSX. TSX. Okay, ticker is just L. Loblaws. Okay, so and these guys have a beta of 0.186, so these are all over the place. It depends really what you're tracking the performance of this stock against. And yeah, I mean they're so far off. It really makes a difference. We've got 0.186. We've got 0.006. Where's the beta? There we go. 0.059. They're all over the place. So check your betas. Make sure they're in line. Let's just check out Finance Yahoo, maybe .ca. I don't even know if that exists. No, doesn't look like it. All right. Well, I'm gonna go with this one. It's the biggest one. And this is arguably, indicating that this is the most risky. So from a conservative standpoint, I'm going to use the highest number. I would recommend calculating beta on your own, but that's fine. 5.9 risk-free rate. Now we had found a risk-free rate in our project that I posted online in the AECon example. Just opening it up here. Financial models already open. Okay, so we had our risk-free rate, and this is the US source. I could find the Canadian equivalent, but it won't be that far off. Okay, we're looking for 20 years, long-term hold, 2.62%. Changed a little bit, I guess. Went down actually. 2.62%. So I'm going to rename this cost of capital. And this will be our financial model. So risk-free rate was, what did we say it was? 2.62%. Risk premium. Okay, so for Canadian stocks 4.3, US stocks 4.92. This is just straight out of your textbook. I'm going to go with 4.3. 4.3. So make sure that's correct. 4.3, yes. Okay, so CAPM. You have the formula provided in our formula sheet equals our risk-free rate plus beta times our risk premium, which is the expected return on the market above and beyond the risk-free rate. Cost of capital is 5%, just over 5%. Okay, save this, see if we can do the cost of debt real quick before I end this video. So, in Morningstar, we go to bonds. Now they have bonds outstanding. Not all companies do. Some have just bank debt. But in this case, they do trade bonds, and we were looking for the yield to maturity. They haven't even listed it, so that's fine. Okay, we'll have to take a look in their financials to look at the cost of debt. Next video.